I put together the 7 most common ways that turnkey companies fudge the numbers. Here's where we're going to have a little fun. We're not going to name names. We're just going to dive in. We're going to take the gloves off. Whatever he said I was going to do, sharpen my nails, honey badger it up. This is what we're going to do over the next few slides here. But here's what I'm looking for. This is what I see over and over and over again when looking at other properties, turnkey companies' evaluations. Number one, they don't include or they underrepresent maintenance costs. Number two, they don't include or they underrepresent vacancy costs. They don't include or they underrepresent certain factors like closing costs, underrepresent interest rates, down payments. Typically, there's something left out there. They don't include or they underrepresent property management fees. Oh yeah, that's a common one. They project higher home price appreciation or rent price appreciation. That's an easy way to juice returns. Number 6, they don't include or they underrepresent selling costs. We want to understand what this investment is truly going to return for us. We have to be accurate about what it's going to cost us to liquidate many, many years down the road, maybe 20, 30 years down the road. But we can't forget to put that in the evaluation, as many companies do. And then they inflate their return on investment calculations by doing something tricky. They include tax savings, principal paydown, and or home price appreciation in year 1 of their evaluation. And we know this is buy and hold. And you don't see all of your tax savings. You don't see your principal pay down. You don't see home price appreciation in year 1 because it doesn't hit your bank account in year 1. Certainly not home price appreciation. You see that when you sell. And principal pay down as well. It doesn't come to your bank account. It just reduces your loan costs. So this is a sneaky one that many companies do as well. So those are your 7. These are all used very commonly. At the end of the day, the reason that they use these is because people believe that higher returns on investment will attract more eyeballs. And many times that's true. JWB, we think about it differently. We're here to manage your financial outcome. And we need to be accountable to, producing a certain return on investment at the end of your 10 or your 20 or your 30-year hold. And so if you start to play some of these games and fudge some of the numbers, you're never going to show up later on and, earn the trust, continue to earn the trust of those folks that put their trust in you to manage their money. So let's break down this pro forma together here. This is the actual turnkey property pro forma here for this Cleveland, Ohio turnkey property here. First thing, the picture. This is clearly an older home that has hopefully been renovated. Here are their purchase and renovation costs, their assumptions, and then their investment returns. And I know it's a lot of numbers. I'm going to try to make it as easy to see as possible. I highlighted the things that I think we should pay attention to. Number 1, the purchase price. Purchase price under $155,000. That's the reason why Cleveland gets a lot of eyeballs. And especially a lot of newer investors are attracted to a market like Cleveland because low initial investment compared to other markets. So that's certainly appealing. But, we got to look beyond what the purchase price is. We're looking for value. People invest in value, or people continue to invest in value. Sometimes they invest for a low purchase price. They don't find value. And unfortunately, they have a bad experience. So that's the purchase price. But look here, rehab cost. This is their standard pro forma. And this is something just to point out. It's very common in the turnkey space. Many times a quote unquote turnkey company will say that they're turnkey, but it's really not turnkey. Remember, turnkey is vertically integrated. Turnkey is where a company owns the land, they build a house, they put a resident in that home that signs a long-term lease, and then they sell you the home and they do all the management for you. So you don't get a property that needs renovations or a rehab. You are sold the property after that's already happened, and then there's a resident already living there. And this is important for a couple of reasons. Number 1, risk mitigation. Who's on the hook when the renovation costs go over? Most of the time, you are. How often do renovation costs go over? All the time. I know this because I renovate thousands of homes each year. That's just what happens. But who bears the cost when JWB goes over on a renovation? JWB does, right? This is about creating a wonderful experience for you as a client. So when you see things like what are the rehab costs in a standard evaluation, their typical way of selling a property is to do a renovation where you're along for the ride. And they put this into their evaluation. So I don't know if they renovated this ahead of time or they just bought this property and then just flipped it to the investor and didn't do any renovations. I think that's probably more likely, and that's more concerning because now you're set up for additional costs down the line as an investor. So warning sign right there. If you see rehab cost or renovation costs and you're thinking about investing in that turnkey rental property, understand that you're going along for the ride. The renovation risk is on you. And then, oh, by the way, there's no chance for you to collect positive cash flow day one because it's going to be renovated for a while. And then after that, it needs to be rented by the property management company. So just some things to pay attention to. Not 100% certain if this has been renovated or not, but you'll know when you look at future evaluations. Assumptions and projections. All right, so there's this rehab cost overrun. They're expecting that rehab costs are going to go over 10%. Again, you're probably on the hook for that. Their vacancy rate, 0%. We're going to talk a little bit more about that. They've got their appreciation rates. They've got their income, which would be rent increases that they expect. They've got their expense increase, which would be things like property taxes, maintenance costs, vacancy costs, all these things that they've got here at 2%. They've got selling costs at 6% of the sales price. That's low because when you go to sell a property, you don't only have the 6% fee that you pay a real estate agent. You also have selling, holding, and closing costs. When you go to sell the property, it doesn't sell day one. You typically have to carry the cost, the mortgage, and other costs for a period of maybe 2 months before the house sells. Those are holding costs. And you also have closing costs on the other side. So the standard way to evaluate that we put in our evaluations is a 10% cost for your selling cost. So this is underrepresented, just like one of those 7 factors that I pointed out. Depreciation periods 27.5 years. Interesting thing here is as I break down how they calculated their depreciation, I'm going to show you how that's a little bit off there. And that's related to this land value thing here. Just keep this in mind. I'm going to break it down a little bit more, but they put their land value here at $0. I'll reference that in just a second. We've got our investment returns that they put together here. And I don't know about you guys, but there's a lot of numbers here. If you put this in front of me and you ask me to put my money into something, I don't know which of these numbers I'm supposed to hold you accountable to. That might be by design. It might not be. But I certainly don't know which number I should be held accountable to. It's confusing. And I think, many times turnkey companies will do this to give themselves an opportunity to flash a really high return number, like 1,250% or 31%, as well as, showing more realistic numbers like this or this. So it's kind of a way for them to kind of like play both sides of it. And, from what I would expect, if there's a salesperson on the other side and you give them the free rein to tell somebody who's going to invest with them, choose one of these numbers to help your clients, be held accountable to, well, they're probably going to choose these numbers over here, these higher numbers. You're probably not going to get realistic expectations. But again, I am making a few assumptions there. I haven't been on the sales call with these folks, but definitely watch out when you see many, many numbers. You guys probably know the salespeople probably choose the higher ones. All right, so now we're going to break down how did they fudge the numbers part 1. This is this turnkey company in Cleveland, Ohio. This is straight from their pro forma. This is their rental income pro forma. And the first thing I highlighted here is vacancy costs. There are no vacancy costs ever. Not in 30 years are they telling you will ever have a vacancy. I would love some crowd participation. We have many clients who are here in the audience here. What do you guys think about the chances of not having any vacancy? Or what do you guys think about the chance of having no vacancy for 30 years? I would love to see. There we go. Pablo says 0. So they're renting it to the house to a tenant for 30 years, says the MVP Lee Bishop. Yep, Michael Santorios, that says that would be a 0.0% chance. Saren says 0. Yeah, all right. So, I mean, no other way to say it other than they're fudging the numbers here, right? And this is very, very common. I have heard other turnkey companies explain it this way. Well, you know what? They're buying the property from me, from us. We're not vertically integrated. There's another property management company that we refer to. So my responsibility is to only put in the evaluation what I am selling them, which makes no sense and just goes back to the first question you should be asking. You should be working with a vertically integrated company because that mentality doesn't make any sense. Our job is to produce a financial outcome for you. Our job is to help you maximize this return on investment. And it's ludicrous to think that you're not going to have any vacancy costs. It's a part of the game. But, somebody who's only been investing for 6 years, they might not know that. I don't know if it's malintentioned or it's just lack of understanding. But it doesn't just stop there. There's no maintenance cost anywhere in this pro forma. I looked top and bottom, and there's no maintenance cost anywhere. Again, I could poll the audience. You guys know this. For those who own rental properties, you are going to have maintenance costs. You want to work with a provider who explains this to you, puts it in their pro forma, prepares you for it. And then when it happens, you're not surprised. This is how JWB clients are able to hold on for a full market cycle and see the value of this beautiful asset class. It's because there's no surprises. But when you invest in this company's property in Cleveland here, you are definitely going to be surprised. You're going to be surprised when vacancy happens and when maintenance costs happen. All right, next, we've got no tenant placement fees ever. So if you run the calculation here, this number is 8% of the gross rent. They charge a 8% property management fee, which is low. You probably get what you pay for, but let's just say that that is a standard level of service. Under no circumstances do they ever increase that property management fee, meaning that there's no tenant placement fees and there's no lease renewal fees ever. So they are truly banking on you buying this asset, then putting one tenant or resident in that home, and that resident staying there for the next 30 years, you never having another resident. Because if you had another resident, there would be another lease tenant placement fee. Oh, no, by the way, they're assuming you're never going to have a lease renewal fee, which well-run property management companies charge a lease renewal fee. So again, fudge in the numbers, no other way to say it. And then here, they're underrepresenting the increase in operating expenses. And here's, you can kind of see it here. It says operating expenses 2%. JWB expects a 3% increase into the operating expenses. Just operating expenses are things like, property taxes, insurance costs, property management fees, right? But it also includes a couple other things that they're not counting on here. It doesn't include maintenance costs as well. Maintenance costs also should have a 3% increase on them year over year over year. You're not seeing any maintenance costs here, and you're not seeing the 3% increase on operating expenses on those maintenance costs. So I know I'm getting really into the numbers here. I kind of like it because, me, I'm kind of a data nerd. I hope it's not too numbers driven, but I want to arm you guys with what to look for as you're going out and you're buying properties. You should know what to look for here, and hopefully this helps you be educated for what not to look for. But it doesn't stop there. We've got part 2 here of how they fudge the numbers. We've got our home price appreciation. This is interesting. Most turnkey property companies budget on the high end. But those who are inexperienced or don't know how to evaluate their home price appreciation in their market sometimes budget on the low end. So they actually were too low on their home price appreciation. They don't have access to the same type of information that JWB has, where we pay a hefty amount of money every year to our consultants to be able to give us the data, not just for the Jacksonville market, for every market out there. And so this company seems like they just put a number out there, and they're actually too low. Their market appreciation is actually 3.5%. They're only at 3%, sign of an inexperienced operator. Rental income and rental increases. You can see here they chose 2%. They're actually too low on that as well. I think it's 2.6 or 2.8% is what you see in the Cleveland market. So an inexperienced operator there. And I got really into the weeds here, and I won't go completely into it, but ultimately their depreciation expense is that's the tax savings component. It's a big part of the tax savings component. They underrepresent they overrepresent the tax benefits by doing a couple of sneaky things. One of the ways, when you are estimating what tax savings should be, you have to separate land from building costs, because the IRS code allows you to depreciate the building. So in your property, there's both land costs and building costs. Makes sense, right? Well, you have to separate the land costs, because if you depreciate everything, you're depreciating land. Land doesn't break down. And so you have to separate that. If we go back to the first slide, if you saw what their land value was, they put it at 0%. Well, they're over-representing the tax savings because they are depreciating land. And in addition to that, their calculation's incorrect. I spent a lot of time trying to get to this number. And really what you do is you take the purchase price. Generally, you knock off 10% of that for the building value. And then you divide that by 27.5. That number doesn't add up here. So I'm pretty sure their calculation is incorrect. I don't have their formulas, but I couldn't make any sense of it. So there's your part one and part two for how they fudged the numbers. And I don't know if we got 3 Q&A. Let's see what we got here. Zahirul, new name. Welcome to the show, Zahirul. He asked, most of Florida, the appreciation is more like deflation, especially in the West Coast and also in Jackson, where most of my rentals are. All right. And so, okay. So let's talk about that. I'm not sure what the question is, but I can just kind of comment on that a little bit. You know, there is a lot of misconceptions when it comes to home price appreciation. The most important thing for home price appreciation is to evaluate it over a full market cycle, because this is about buying and holding. And so short term, 1 year or 2 year or 3 year home price appreciation is the least most important part of the equation. Because higher interest rates have been here for longer, ultimately that is dampening demand, and you are starting to see some home values decrease. Jacksonville is a market where we see about, I think it's about 1.4% home price decline so far this year. Now that could change. But all that's happening here, and Zahirul, I hope you continue to come back, because, and I really hope that you download this, go and request this market report. You're going to learn so much by going there. Go to jwbrealestatecapital.com/report. I broke down what that decline means and how this is actually a great time to invest, because ultimately what's happening is it's dampening demand, but it's not eliminating it. We look back in history at other times where there were high interest rates, and what we saw is that home sales were down, home values were lower, but then what happened as soon as interest rates went low again, got lower, you saw home sales rage back. You saw home price appreciation come back at very high levels. And again, detailed a lot of that in this report. So I would encourage you to download that. Again, you can go, there you go, Johanna put it in the chat here. That's a great learning opportunity for you, Zahirul. And thank you so much for being a part of the show. And then HTTN asked, is this a repeat show? Did you have this info in a previous show, maybe a month ago, or am I flipping? You are flipping a little bit. We haven't done this show in over a year, actually. I believe it was, I went back and I looked, I think it was about a year. So we have done this concept, and about a month ago, what we did is we broke down and built a portfolio for a client. That might be the show that you're thinking about, but this one has fresh data, a fresh eval, and it's new as about a year ago. And the Bishop, the MVP says, why do you suppose they're lowballing the numbers? Well, you know, Lee, at the end of the day, they're doing that because they believe it helps them sell better. And it's a short-term mindset. And it does increase sales for people across the country to have a short-term mindset, to inflate the numbers, you know, but at the end of the day, people choose to come back and reinvest based on the experience and on the value. And if you take shortcuts and you inflate the numbers, you are setting yourself up to lose people's trust. They're not going to come back to you. So our approach is, let's just show everybody what it is. These numbers are great. You know, when you actually talk about them and show them for what they are, they're still really good. They're not 16% and 31%, but that's not real anyways. You know, so our approach is, let's just show everybody, because again, when you're vertically integrated, you're not just buying and selling. You're not just helping people buy and sell. You are managing outcomes. You're managing experience. So great questions, guys. You can keep them coming. I'm going to keep going as well. So what I thought we would do is rerun their pro forma with correct assumptions. And so that's what I did. The other guy's pro forma showed that they were going to earn $294,000 from this one property over a 20-year hold, with an estimated rate of return of 16%, 15.6%. I chose that one as the most kind of realistic return out of the plethora of returns that they chose out there. So 294,000 with a 16% rate of return. When I reran their pro forma, used all of their numbers and just actually calculated things the right way and put in things like maintenance cost and vacancy cost and used their accurate home price appreciation and rent price appreciation numbers, which actually boosted their returns. is a very different story. Their profits are about $80,000. So not 294, just about $80,000 for this property with an estimated rate of return of about 11%. Very different. Very different. And again, hope you guys are seeing why many people go to a place like Cleveland, work with an inexperienced operator, take that leap of faith, do this one time, have a bad experience, and are out of the game. Trying to avoid that. Hopefully this show helps do that.